Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Welcome to Bachelor of Management Universitas Muhammadiyah Yogyakarta video. This video will discuss about analysis of financial statement. Financial statement still need to be analyzed to give more information. There are many kind of analysis of financial statement. The first one we will discuss about ratio analysis, and then we will discuss about Dupont System, and then we will discuss about common size and also percentage change analysis and how limitation of the ratio analysis. Ratio analysis. This financial ratio are calculated by combining the number of balance sheet with or the number in other statement. For example, from the income statement. There are five major categories of ratio. The first one is liquidity. Liquidity tell about can we make requirement payment as they fall due, or is that the company can pay their short-term debt. And then the second one is asset management. Asset management tell about have the company have the right amount of asset for the level of asset. And then the third one, debt management, we have the right mix of debt and equity. And then profitability. Profitability tell about is the sales price exceed the unit cost. Are the sales hike enough to as reflected by profit margin, return on equity, and return on asset. And then market value. Do investors like what they see as reflected in price earning ratio or market to book value ratio? This is a liquidity ratio, a ratio that measures the company ability to meet short-term obligation. Liquidity ratio can be measured by current ratio. Current ratio is current asset divided with the current liabilities. And also we can measure the liquidity ratio with quick ratio. Quick ratio is current asset minus inventory and divided with current liabilities. If the company have this ratio more than one, it means that the company have ability to meet short-term obligation. Asset management. Asset management is a ratio that measures the company ability to use its asset efficiency. What is the inventory turnover? Yeah, inventory turnover can be measured by sales divided the inventory. We can combine the ratio of the company with the historical data or with the industrial data. If the company combined with historical data, they can use the data from time to time, or they can combine the data with the industry data. So they can combine in the certain period with another company or the average of industry. Asset management. Asset management can be measured by days sales outstanding. Days sales outstanding is the average number of days after making a sale before receive the cash. And this ratio can be measured by receivable divided average sales per day. And then another asset management ratio. This is fixed asset and total asset turnover ratio. Yeah, fixed asset turnover we can measure with sales divided net fixed asset. And total asset turnover can be measured by sales divided total asset. So in this ratio, we can also combine the or we can compare this ratio with historical data and the industrial data. Debt management. Debt management is a ratio that measures the company's ability to meet its total obligation. We can calculate the ratio in debt management with debt ratio. Debt ratio is total debt divided with total asset, or time interest ratio. Time interest ratio is earning before interest and tax divided with interest expense. We can also use EBITDA coverage. EBITDA coverage is earning before interest and tax plus depreciation and amortization, and also lease payment, and divided with interest expenses, lease payment, and loan payment. Profitability ratio. Profitability ratio is a ratio that measures the company's ability to generate the profitability. We can measure with several ratios. We can use profit margin. Profit margin is net income divided sales, or we can use basic earning power. This ratio is earning before interest and tax divided total asset, or we can use return on asset. Return on asset is net income divided total asset, or we use return on equity. Return on equity is net income divided common equity. Market value. Do investors like what they see as reflected in price earning ratio and market to book value ratio? Price to earning ratio is price per share divided earning per share, and earning per share is net income divided share outstanding. Market to book value ratio we can measure with market price per share and divided book value per share. Book value per share is common equity divided share outstanding. And cash flow per share is net income plus depreciation divided share outstanding. Price per cash flow is price per share divided cash flow per share. Another analysis of financial statement, we can use common size analysis. Common size analysis, we can divide all items in the balance sheet, for example, in here. So we can see in balance sheet, in the asset side, we can see that all items in asset divided by total asset. So based on this analysis, we can see the proportion of each item in the balance sheet, if we compare with the total asset. In the total liability and equity, we also can analyze how much the proportion of all items in this balance sheet. How much the proportion of the liability and how much the proportion of the equity if we compare with total liability and equity. In the income statement, we can also analyze with common sense. We divide all items in income statement by sales. So we can see, for example, in here, cost of goods sold is 80.4 if we compare with sales in 2000, and etc. And we can also use percentage change analysis. Percentage change analysis, we can choose 1 year one certain year as a basic year, and then we can calculate how much the change of each account in the finance statement if we compare with the basic year. We can use percentage analysis for balance sheet and also for the income statement. Dupont System. Dupont System is analysis that include profit margin, total asset turnover, and equity multiplier that give impact to return on equity. There are benefits and the limitation of financial ratio analysis. The benefit of financial ratio analysis: this ratio is standardized numbers, facilitate to make comparison, and this analysis can be used to highlight weaknesses and strengths of the company. But this analysis have limitation. The limitation is this analysis, comparison between industry average is difficult if the firm operate many different divisions. The second one, the average performance is not necessarily good, and seasonal factor can distort ratio. Sometimes window dressing technique can make statement and ratio look better, and different accounting and operation can distort comparison. Sometimes it's difficult to tell is that the company have a good or bad performance. Sometimes different ratio give different meaning, so it's difficult to tell or balance whether the company is in a strong or weak financial condition. Thank you for watching my video, and wassalamualaikum warahmatullahi wabarakatuh.